On March 31st, remote tech workers across the United States, India, Canada, and Mexico woke up to start their day. At exactly 6 a.m. local time, automated emails from corporate leadership arrived in their inboxes. There was no manager warning and no exit interview. The email stated their roles were eliminated and all system access was revoked within hours. Mid-August internal directives reveal that Oracle leadership has instructed unit managers to prepare immediate lists for another round of double-digit percentage headcount cuts. The mandate is strict. These payroll reductions must be finalized before the second fiscal quarter opens on September 1st, 2026. Out of the 21,000 positions Oracle eliminated over the past fiscal year, industry estimates suggest roughly 12,000 occurred across operations in India. Legacy software divisions, support functions, and Java middleware teams are bearing the brunt of these eliminations. Oracle is treating its human personnel as a liquidatable resource, liquidated with machine-like efficiency to reallocate capital toward compute infrastructure. Oracle Cloud infrastructure revenue surged 77% in a single year, even as the company eliminated 21,000 roles. Total global headcount dropped from 162,000 to 141,000. Despite this record-setting revenue expansion, Wall Street remains skeptical. Oracle stock has declined approximately 26% year-to-date. There is a stark disconnect here. Companies typically execute mass layoffs and suffer stock drops during a period of corporate decline, not during a cycle of record-setting revenue expansion. Building the infrastructure required for artificial intelligence workloads demands vast physical resources. To purchase high-density hardware, acquire land, and secure industrial power agreements, Oracle committed $55.7 billion to capital expenditures in fiscal 2026. This expenditure drastically exceeded the money the company actually brought in. After accounting for that $55.7 billion spend, Oracle was left with a $23.7 billion cash flow deficit. To bridge that gap, Oracle turned to capital markets, issuing $43 billion in new debt and signaling plans to raise another $40 billion. Management is choosing to leverage the company's balance sheet to the limit, betting that building raw compute capacity is more important than near-term financial stability. Oracle treats human payroll as an operational cost that can be liquidated and permanently converted into long-term hardware assets. Personnel expenses saved from workforce reductions are channeled directly into data center real estate, power agreements, and specialized compute clusters. The company has explicitly noted in regulatory filings that the adoption of artificial intelligence tools is contributing to reductions. Internal generative artificial intelligence models are now automating routine tasks like Java code maintenance, rendering specific engineering roles completely obsolete. The transition is expensive. Oracle's restructuring and severance charges reached $1.84 billion in 2026 and are expected to hit $2.1 billion. They are spending billions to push workers out to move more capital into the server racks. This strategy assumes machine assets will eventually generate software returns exceeding the productivity of human workers. This isn't just an Oracle anomaly. It is a pattern emerging across the premier technology sector in 2026. Amazon eliminated over 18,000 roles to remove layers of bureaucracy, freeing up the capital required to fund AWS infrastructure and custom silicon. Block cut roughly 50% of its workforce to shift toward AI-native operations, while Meta eliminated roughly 6,000 roles to reallocate resources toward research and compute hardware. Across the industry, high-profile firms are systematically downsizing headcount to purchase the compute power they believe will define the next decade of software. The AI value chain is divided into 3 layers. At the base are high-margin hardware makers. At the top are AI labs and developers. In the middle are the cloud hyperscalers like Oracle. By taking on tens of billions in debt to build data centers for third-party developers, Oracle is acting as the primary credit leverage bridge for the entire ecosystem. They are borrowing money to build capacity for clients who are often still operating with negative cash flows. This creates a significant counterparty risk. Should those AI developers face funding shortages, Oracle's multi-billion-dollar infrastructure investments could face sudden underutilization. If demand for cloud compute plateaus, Oracle will be trapped with depreciating physical assets and massive debt obligations, but without the human capital required to pivot its software offerings. While AI hasn't caused a spike in overall unemployment, it has fractured the entry-level hiring pipeline. For tech workers aged 22 to 25, employment levels in technical fields have dropped by 13% since late 2022. Companies are raising the barrier to entry, demanding that early career engineers possess advanced automation competency on day one. The junior roles that once involved routine code maintenance are being phased out in favor of automated tools. For decades, these glass towers and the massive headcounts within them were symbols of corporate prestige. In the previous era of big tech, human talent was the primary asset companies competed to hoard. Oracle's trajectory suggests a new priority for the sector. When the budget is squeezed, the server racks are protected, the employees are not. Success is no longer measured by the size of the workforce, but by the scale of the compute.